So today we're asking the question, pay off debt or save first? And I'm going to give you a side by side comparison of a real case study, and you can decide for yourself which one that the person in the case study should do. Welcome to the FIFE Movement. I'm your host, Amanda Neely. This is the only movement that helps our generation create our unique feminine and entrepreneurial path to financial independence. Please be sure to subscribe. And if you're watching on YouTube, hit the bell for future episodes. So I want you to meet Sam. Sam is a 23-year-old who feels this way. Sam says, with the debt that I have, it's hard to enjoy life. I have to worry about all the payments. Sam also says, I want to buy a home, but how much do I save for a down payment? These are the two big things for Sam, the debt and wanting to own Sam's own home. So currently, Sam is setting aside $700 per month in savings. Sam also has about $20,000 in student debt with an average interest rate of 4.27 and is paying $207 a month, just the minimum on those student loans. And then also a car loan, a little bit lower interest rate, but about the same balance, $20,000 at 2.9%, but the monthly payments higher, $384. So that's a total of $1,291 that is currently going to savings and debt. And Sam is asking, am I doing the right thing? Should I do something different? And particularly, most people would look at two options. What should Sam do? Option one, put that $700 toward her student debt and her car loan so she gets out of debt as quick as possible and then save for that home. Or option two, continue to save that $700 for the home and only pay the minimum on the student debt and the credit card or the car loan. Sorry. So I ran the numbers. And if Sam does option one, remember putting that $700 toward the debt first, once the debt's paid off, then save for the home. I did the calculations. Really awesome. The debt would be paid off 88 months earlier, so in 29 months, and the interest saved would be a little over $4,000. That's pretty good. And then if Sam started saving that 1291, the 700 that was going into savings, right? And then the two loan repayments. So she added debt, all of that can go into savings. And to run these numbers, I used a properly designed high cash value dividend paying life insurance policy. As many of you know, I'm a bank on yourself professional. This is where I save, a lot of our clients save, and what people want us to create YouTube videos about since this isn't talked about on many YouTube channels. So, just full disclosure, that's what I used here as the savings mechanism. What I found was that Sam could have that $40,000 down payment in 7 years. So 2 years of paying off the debt and then 5 years of saving 1291 into a policy. Then Sam would be able to take $40,000 as a loan against the policy and use that for the down payment. And then when we fast tracked, continue to save that 1291 for the long term. When Sam was 70 years old, Sam would have $1.8 million and some change for retirement. Not too bad. That looks really good. That's what most people would do. Let's look at option two, just to be fair. Option two is to save that 700, only pay the minimums on the debt, and see what happens. So here, Sam would still save some interest because we're not just putting the money into a policy and never touching it. We're putting it into the policy and then we're using it to pay off the debt when the debt and the policy cash value are equal. So it still saves a little bit of interest, about $660 by using the policy to pay off the debt, rather than just putting those payments directly toward. And then, so putting that same $700 into a policy, and then once the debt's paid off, starting a second policy with $591 per month. And again, I'm using bank on yourself type whole life insurance, properly designed and everything. So Sam could have that $40,000 down payment in 6 years instead of 7 years, like on option one, so a year earlier. Um, and Sam could have $1.9 million at age 70 for retirement. So let's compare these two options side by side. So option one was to put that $700 toward the debt first, and option two was to save first, and only pay the minimums on the cards, the student loans and the car loan, and see where it goes from there. So what we found was that doing option one, Sam could save about $4,000 in interest. Doing option two, Sam could buy a home a year earlier and have about $100,000 more when she's 70 years old. Now, there's a lot of factors here that we can't factor in. We could add to this, right? Maybe an option two, by buying the home a year earlier, she's able to buy it at a lower cost because it hasn't, appreciated as much. Or maybe if she has her income change, she's still able to pay off the debt more quickly. Or, there's all kinds of things that could happen. But if we're just comparing apples to apples, same exact dollars, same exact down payment, all those kind of things, this is what would happen. Um, so my question for you is, what should Sam do? And if you're totally the analytical type, you want to see the numbers behind, the year by year analysis, how we got all the data that we put into this episode, please check out this video. It's a live episode that me, Brandon, and this guy named Mark did, called "Should I Use Dave Ramsey's Snowball Method or the Snow Bank Method?" which is trademarked by Mark, the dude up here in the corner. I'll put the link to that YouTube video in the description of this episode. But I hope this was helpful to you in helping you see the pros and cons of thinking short term, wanting to get out of debt as quickly as possible, right? Or thinking long term, how much am I going to have when I'm 70, kind of thing. And there's different reasons to think both ways. But then also competing priorities, which is more important for Sam, is what I would ask Sam. Is it more important to not have any debt? Is it more important to buy a home a year earlier? Is it more important to have a safety net that you can fall back on? And in terms of that safety net, tomorrow's episode, I've got some really great ideas for you about how safety nets can be really important for entrepreneurs in particular. Sam, in this example, we didn't even talk about entrepreneurship and how that would play a factor. So we'll do that tomorrow. For now, thanks for joining me and connecting with the FIFE movement. As you go about your day today, remember, wealth is coming your way. Your quest is to prepare for using it well. For more tips on how to prepare, be sure to subscribe. And to connect with the community, visit fifemovement.com. If my gift has helped you today, please pay that gift forward by sharing this content with a friend. My gratitude in advance. To help this video be seen by more people, please hit the like button. We invite your feedback in the comments too. What other things should Sam consider as she's trying to choose option one or option two? Please share.